Welcome back to the Brent Bruce Daily, where each day we take a look and see where home loan interest rates really are, what is making them move, and what to expect for the future. Now, that is what we're really going to talk about here today because today is May the 1st, 2023. It's now after 4 o'clock p.m. Central Time, which means the bond market and the mortgage backed securities are closed for the day. We're going to take a look at that here in just a minute, but we're going to focus on the future for just a minute because that is what everyone has been asking me. Now, May is a big month for us. If you're a baseball guy and you watch Major League Baseball, you know that October is what you're really looking forward to. That is when the World Series is played, when we really find out who is the champion of that season. Well, May is looking like this is when we're going to find out who is the champion of the inflation fight. Okay, so this is when we're going to find out if inflation has really started to turn and we're really going to see home loan interest rates turn around and we're going to start to now benefit from all of the effects of the Federal Reserve increasing their federal funds rate. A lot is going to be determined this month, the month of May, even to the point that I think even halfway through this month, I will concede that I am incorrect with my projections if I don't see the movement that we need to see here in the next 2 to 3 weeks. That's really going to tell us if we just could not beat inflation and get our interest rates back to where they need to be. Now, if things work out, then guys, we were talking about my projection way in January of being at 4.999 or under 5%, 4.875% with no points at all on a 30-year fixed mortgage on the Brent Bruce Daily. Now, that is still a long way to go, but May is going to be the month that's going to tell us if it's going to happen or not. And it all starts with Wednesday of this week. The Federal Reserve is meeting. They're starting tomorrow. Their meeting begins tomorrow. They meet, they deliberate, and they come out and they make an announcement on the 3rd, which is Wednesday, as to what they're going to do with the federal funds rate. Now, it is highly anticipated, if not actually expected, that they will increase the federal funds rate another 1/4%. That causes things like home equity lines, auto loans, credit cards to go up immediately. Okay, they go up right away. Any type of adjustable rate mortgage that is tied to the prime rate, because the prime rate rides on top of the federal funds rate and is directly affected by the Federal Reserve increasing the federal funds rate. It does not directly change mortgage rates on a standard Fannie Mae, Freddie Mac, FHA, VA, USDA basic home loan, the loans that we do, the everyday lender does and the everyday real estate agent does. We're not talking about construction financing or anything like that because that can be different. So the thing that we are looking for, though, is we're looking for the comments from the Federal Reserve. And this is what we think is going to come out. The Federal Reserve is going to increase the federal funds rate by 1/4%. But they're going to say that most likely something is going to indicate that they're going to pause. So they've done what they want to do. They've revved up to the point they want to be at. And now they're going to start to just level off, leave the federal funds rate alone for a number of months, if not longer than a year, to let the effects of these increases take hold of the economy, which I think is the right move. It should have actually probably not increased the federal funds rate last time because I think the effects are already starting to take shape. Now, if they make those announcements or even lean in that direction, the market is going to love it. It is expected, but they want it confirmed and they will begin to feel better and the bond market will like that. They will rally, home loan interest rates will begin to come down. Now, after that, we actually get another report on Friday, which is the employment report. Now, if you watch this show faithfully, you know that back, I believe it was in February, we received the jobs report that came out of nowhere and said that jobs for January were through the roof, explosively wonderful, which makes no sense at all. It still doesn't now. And they later on made a lot of adjustments to those numbers back down. But that caused home loan interest rates to go up from 5.875 to 6.875 in about 3 weeks. So that shows you how volatile the market is and how much that employment number and jobs number can affect home loan interest rates. Okay, so again, we were celebrating 5.875. We were in the fives with no points and it shot back up to almost the sevens because of that one report. That report is coming out this Friday. We have the Fed meeting report and that jobs report coming out here this same week. Now, coming after that, so the 10th of May, the 10th of May, we're getting the consumer price index report coming out, as well as the producer price index report. Those are going to be key because those should show a dramatic drop in interest rate according to the consumer price index and producer price index readings, which again is going to say, okay, now we're getting the Fed saying the same thing. Maybe we're getting employment numbers saying the same thing, the CPI, the PPI, and then at the end of the month, we'll get the personal consumption expenditures reading. And all of these things should start to roll over and show inflation subsiding, especially because housing, which is a huge component to these reports, is going to begin to catch up. So again, housing is a trailing car on the roller coaster. So as the roller coaster is going over the hill, housing is here at the end. It goes up still before it begins to follow the head of the roller coaster, which should really start to show itself in May. So all of the data points to May being where we really start to see a drop in home loan interest rates. May and June is where we're going to go, where we will need to go from today, about 6.5%, 6.75%. We're going to look at that here in just a minute, all the way down to 4.875 or maybe 4.999 with no points at all on a Britt Bruce Daily in 2 months. So it's going to be action packed. So let's take a look and see where we are right now. I know this is a little bit longer report, but guys, this is a big month. Okay, this is the World Series month. All right, so this is the big October. And right now, we're not starting off very strong. We're down 31 basis points, up 14 on the 10-year Treasury. Why is that? Probably because the banks in the market in general, man, I'm telling you what, they want to hear from the Fed. They want to hear the comments from the Fed. They want to ask questions and hear how Jerome Powell responds to the questions about what they're going to do with the federal funds rate. And if this is most likely the last increase to the Fed fund rates in this cycle. Now, remember, if you have a home equity line of credit, when the cycle begins to level off, you'll stop seeing those payments going up. And when they start to bring it back down as inflation subsides, they will bring the federal funds rate back down. They don't want it as high as it is. They're doing it because they have to constrict on our economy. And as they bring the federal funds rate back down, your equity line payment goes down as well. Your credit card payment goes down as well. Your new auto loans will become cheaper as well. Construction financing will become cheaper as well. So you'll be able to ride that down as time goes on, which will be a relief for us as well as we move forward. So right now, again, we're up down 31 basis points. You can see very clearly, man, if you watch this show very often, it's amazing how accurate and real these technical indicators are. Look at us drop below. We dropped all the way below the 50-day moving average, bounced back up to stay in this range above the 50-day moving average, shot all the way back up, almost hitting the 200-day, and we're staying within this range. Okay, the market now is closed, and we closed at 100.45, so we're sitting right about here towards the bottom of this candle, really all the way down here. All right, so we're at 100.45, and we got a long way to go before we're going to start battling our 200-day moving average, which is really, I guess it's not that long. It's only about 0.4, so 40 basis points to where we're fighting our 200-day moving average. Now look, we'll go 40 basis points in a snap. We'll be up 40 basis points in a heartbeat if we get the comments that we want from the Federal Reserve. If we get the employment number that we want, we can go up 100 basis points in a day. Okay, so we might see dramatic improvements to our mortgage-backed securities and allowing our home loan interest rates to come down. Again, I do also believe that the banks right now are holding on to a lot of margin. They're holding on to a lot of margin because of the volatility and the importance of this big month of May. Where are we right now on our home loan interest rates? We are sitting here, let's run this scenario on our very well qualified 30-year fixed conventional, 800 FICO score, 25% down home loan. While we're running these numbers, make sure that you do like, subscribe, share, hit the notification bell up in the top so you get updates, each and every time I put something out, which is almost every single day, unless I'm just too darn busy writing home loans that I can't get these numbers out, which is, a good thing as well. So let's take a look and see. Right now, 6.75% with no points, of credit of $266. Okay, so Not that great. I mean, but there again, I was a little worried that we'd be 6.875. Okay, so 6.75 I'm happy with right now. Let's open this up here and see what it takes to get to the 5.999. Right now, this bank 11 mortgage is costing 1.87 points. Let's take a look at United Wholesale, which is what we like to do every day. To get to 5.999 is costing 1.4. So we're still about 1.4% away from being able to get to the 5.999. If you don't know what I'm talking about and you don't know what points are, you need to go back and watch some of my other videos. So again, let's take a look here quickly at the parameters. These are the parameters that we're using here for our compliance purposes. Let me know if you have any questions, comments, concerns. You know, guys, I'm getting comments every day now. Almost every single day I write back and respond to comments as our subscriber base has grown. And people have questions and people want to understand more about what it is I'm talking about on some of these topics. You can definitely reach out to me. And the other thing, make sure you keep in mind is that I am a mortgage broker. I write home loans every day. Okay, so, and I'm getting pretty darn busy here as the interest rate market is stabilized at least. So we're not seeing increases. It's stabilized, but people are just out buying houses. They're trying to buy houses right now and just get through where we are at right now on price. So let me know if I can help with either of those items. Make sure that you reach out. Make sure you like, subscribe, and share, and I will get back to you again tomorrow as the Federal Reserve begins their meeting on Tuesday and their announcement on Wednesday. We'll talk to you then.